The Federal Reserve is frequently in the news for its role in shaping the economy. Understanding the Federal Reserve and what it does is important for investors and can help with developing investment strategies. Hi, my name is Gio. Hope you're doing well. In today's episode, let's understand what is Federal Reserve and 7 facts you have to know about the Federal Reserve if you are an investor. But before we jump into it, you can smash that like and subscribe button for the YouTube algorithm. The Federal Reserve System, often called simply the Fed, is the central bank of the United States and the most powerful financial institution in the world. It was founded to provide the country with a safe, flexible, and stable monetary and financial system. A central bank is a financial institution given privileged control over the production and distribution of money and credit for a nation or a group of nations. In a modern economy, the central bank is usually responsible for the formulation of monetary policies and regulation of members' banks. The Fed is composed of 12 regional Federal Reserve banks that are each responsible for a specific geographical area of US. How does the Federal Reserve work? To understand how the Federal Reserve works, you need to know its structure. The 7 members of the Board of Governors with the entire Fed system. They direct monetary policy and set the discount rate for members' banks. Staff economists provide all analysis. The 12 regional Federal Reserve banks work with a board to supervise the nation's commercial banks and implement policy. The Federal Open Market Committee supervises open market operation. The 7 board members, the president of the Federal Reserve Bank of New York and 4 of the remaining 11 regional banks president are members. The Federal Open Market Committee meet 8 times a year. What does the Federal Reserve do? The Federal Reserve has 4 main functions: manage inflation, supervise the banking system, maintain the stability of financial system, and provide banking services. Let's start with managing inflation. This is the Fed's most visible function. As part of this function, the Fed also promotes maximum employment and ensures interest rates remaining moderate over time. As the Federal Reserve conducts monetary policy, it influences employment and its policy tools to influence the availability and cost of credit in the economy. The primary tool used to conduct monetary policy is the federal funds rate, the rate that banks pay for borrowing in the federal funds market. Changes in the federal funds rate influence other interest rates that in turn influence borrowing costs for households and businesses as well as financial conditions. For example, when interest rates go down, it becomes cheaper to borrow, so households are more willing to buy goods and services, and businesses are in a better position to purchase items to expand their businesses, such as properties and equipment. Businesses can also hire more workers, influencing employment. And the stronger demand for goods and services may push wages and other costs higher, influencing inflation. During economic downturn, the Fed may lower the federal funds rate near zero. In such times, if additional support is desired, the Fed can use other tools to influence financial condition in support of its goals. Supervise the financial banking system. The Fed supervises and regulates the nation's largest banks to protect consumers. The Federal Reserve banking system is a network of 12 Federal Reserve banks under the supervision of the Board of Governors. These 12 banks supervise and serve as banks for commercial banks in the region. The reserve banks serve the US Treasury by handling its payments, selling government securities, and assisting with its cash management and investment activities. Reserve banks also conduct valuable research on economic issues. Maintain the stability of the financial system. It maintains the stability of the financial market and constrains potential crises. The Fed's day-to-day activity of conducting monetary policies, supervising and regulating banks, and providing payment services all help maintain the stability of the financial system. These clear goals reduce uncertainty in a financial market and help financial institutions operate efficiently. During periods of financial declines, these activities may not be enough. At such times, the stabilizing action of a central bank take on a critical and immediate importance. When the financial system is experiencing shock, the Fed is prepared to take extraordinary action to keep disruption from spreading across the financial sector and from spilling over the economy. Specifically, the Fed is prepared to provide liquidity, that is, emergency access to cash to financial market and institution in several ways. These include temporary changes to open market operation, lending through the discount window to eligible banks, and operating special lending facilities to financial institutions. This is why the Fed and other central banks are known as lenders of last resort, providing banking services. The Fed provides services to other banks, the US government, and foreign banks. When Congress established the Federal Reserve, it charged the Fed with the critical task of providing a safe and efficient method of transferring funds through the country's banking system. Reserve banks and their branches carry out this mission, offering financial services to all financial institutions in the United States, regardless of size or location. Especially, reserve banks serve as bankers' banks, offering a variety of financial services. They distribute currency and coin, process checks, and offer electronic form of payment. Besides providing currency and coin, reserve banks process commercial checks. Over the past decade, the Fed has led to industry's push to replace paper form of payment, such as checks, with electronic form of payment that offer lower risk and higher efficiency. The Fed now transmitted electronic images of checks and allows electronic deposit and payments. 7 facts investors should know about the Fed. It uses several monetary policies. The primary goal of Federal Reserve System is to promote the goal of maximum employment and stable prices or low inflation. The Fed executes its objectives through monetary supply activities as enacted by its open market operation. 4 tools are used to accomplish its goal: the discount rate, reserve requirements, open market operation, and interest or reserve. These activities influence the amount of funds in the banking system. According to the Federal Reserve Bank of St. Louis, the most powerful monetary policy tool is through its open market operation, that is, purchasing or selling US government bonds. It affects interest rates. Federal Reserve interest rates refer to discount rates. This is the interest rates charged to banks on short-term loans that are received from a regional Federal Reserve Bank. The Fed doesn't set the interest rate, but rather a target range for the rate. The discount rate indirectly influences other interest rates, including the credit card, vehicles, and mortgages loan rates. These rates influencing businesses and consumers' decision on borrowing, lending, and spending. Lower mortgages rates may encourage home buying and therefore support the housing market. It influences the economy. Higher interest rates will slow borrowing by businesses and consumers due to greater borrowing costs. Stock market investors find that higher interest rates generally correspond with lower returns. While lower rates encourage home buildings, businesses expansion, and consumer borrowing, lower interest rates tend to heat up economic growth, while higher rates tend to slow it down. When the Fed raises the rate, it typically indicates the economy is doing well, but a higher rate makes it more challenging for real estate investors as they pay more for the loan. The target for the federal funds rate has changed over the years in response to managed economic conditions. It was set as high as 20% in the early 1980s in response to inflation. With the coming of the Great Recession of 2007 to 2009, the rate was set to record low target of 0 to 0.25% in attempt to encourage growth. The Federal Reserve lowered the Fed funds rate to a range of 0% to 0.25% on March 15, 2020 in response to the COVID-19 pandemic. However, it began raising the rate in March 2022 to combat rising inflation. At the following meeting on May 3rd and 4th, they raised the federal funds rate, this time by 0.5%, bringing the target range to 0.75% to 1%. It makes adjustments to control inflation. The Fed wants inflation to be just right, not too high or too low. When the economy or inflation looks like they are going to overheat, the Fed raised the federal funds rate, its main tool to control inflation. A higher federal funds rate slows businesses lending and cool the economy and inflation. Investors should attend to the Fed funds rate and its ripple effect on loans and stock market prices. It influences financial market. The Fed has a lot of power to influence the economy and indirectly impact how stock moves. While the stock market is not the economy, it can be seen as a reflection on how confident consumers are about the strength of the economy now and in the future. Additionally, the stock market is a helpful indicator of economic changes, well-being, and growth. Investors should keep a close look on news coming out of a US central bank as an indicator of where the market might be headed next. Some say that the Fed chair is the most important person in the world. When the Fed chair speaks, financial market moves up or down. It issues US Treasuries. The Fed's open market operation buy and sell treasury in the open market to help reach its goal. When the Fed buys bonds in open market or from the public, it grows the money supply in the economy by putting more cash in the hands of consumers. Bond buying also affects interest rates. As the Fed buys bonds, the prices rise and interest rates fall. Conversely, by selling bonds, the Fed reduces the money supply by removing cash from the economy. This lowers bond prices and raises interest rates, consequently slowing down a quick growing economy. Typically, investors benefit when interest rates decline as stock market prices rise, and it plays a non-partisan role. The Federal Reserve, like many other central banks, is an independent government agency, but also one that is ultimately accountable to the public and the Congress. It's important for investors to keep that in mind. The Federal Reserve does not receive funding through the congressional budgetary process. The Fed's income comes primarily from the interest on government securities that it has acquired through open market operation. After paying its expenses, the Federal Reserve turned the rest of its earnings over the US Treasury. Investors can purchase government securities at treasurydirect.gov for a steady cash flow. The Congress also structured the Federal Reserve to ensure that its monetary policy decisions focus on achieving these long-run goals and do not become subjective to political pressures that could lead to undesirable outcomes. I know there was a lot of information in this video, so here you have few key takeaways. The Federal Reserve is the central bank of United States. The Federal Reserve manages inflation, regulates the nation's banking system, stabilizes financial market, protects consumers, and more. Although the Fed board members are appointed by the president, it is designed to function independently of political influence. The Fed plays a significant role in financial concerns that affect the lives of all Americans and investors all over the world. Thank you so much for watching. If you find this information helpful, please consider to subscribe to my channel, like this video, and check out all the links in the description down below. See you in the next video.